Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And in today's episode, we're discussing one of what I consider to be the most intuitive factors, and that is quality investing. So quality-based investing is really built to identify those market-leading companies. And research has shown that by taking a quality approach to equity investing, investors can actually earn a premium while reducing risk over the long term. So attractive opportunity for investors. And today we're going to walk through not only how to measure a quality company, but why quality matters and how it differs from other factors, and some ETF solutions that can simplify the approach. Before we get started, a quick reminder that today we're not providing any investment advice or recommendations. Today's all about education and information for Canadian DIY investors. Today, I am welcoming back to the channel, Tony Dong. Tony, it's great to have you. Thanks for being here again today.
Thanks, Erin. Always happy to appear.
To those who are watching, you probably recognize Tony from his written work. He's a writer for many popular publications like the Motley Fool, The Street, Benzinga, and a lot of others in the US as well. He's quite busy, but what you might not know is that more recently he launched a new venture, ETF Portfolio Blueprint.com. So Tony, I'm going to turn it over to you to give us a bit of an intro into this site and really what drove you to launch it.
Sure. So I have a lot of ideas that for some reason or another, my editors don't want to run with. Maybe it doesn't jive with their content schedule. Maybe it covers something that they don't think has a lot of reader interest. So instead of just warehousing these ideas, I decided to give them a place to live. And in lieu of starting, say, a Medium or a Substack blog, I thought, why not go all the way and make my own website tailored to my audience, which is a mixture of American and Canadian DIY investors. So the site has four sections. There's a section for Canadian ETF analysis, and it pretty much covers anything. One week I might be looking at sector ETFs. I actually just did one on oil and gas equity ETFs, and ZEO was mentioned. Another week I might be looking at banks. There's a corresponding one for US ETFs, but the main part of the site are two sections where I share some of my model ETF portfolios for both US and Canadian investors. So these are meant to, cover a broad spectrum of objectives. So you have ones that are tailored towards passive, long-term buy and hold investors, some that are tailored more towards thematic or income investors. And it's really just a way for me to get a bit more creative and connect on a more personal level with my audience.
I love that. I think it's such a great initiative, and you have so much knowledge to share in the ETF realm. I'm always amazed by the quality of insights that you bring to our discussions. So I encourage everybody to check it out. Again, just give it a Google, ETF Portfolio Blueprint, and it'll pop up there. Let's jump into the topic of today, Tony, quality investing. This is one of the many factor-based approaches to investing, but can you give us sort of an intro into what is the quality factor and what does quality investing really attempt to accomplish?
Yeah, sure. So when you think about the types of flavors a company comes in, we categorize them based on factors. This is a long persisting characteristic that a stock has that helps us explain its long-term risk and return performance. Now, the quality factor essentially captures companies that have durable business models, sustainable competitive advantages, and have excellent financial health. So just off the top of my head, there's a lot of quality companies out there that you and I may recognize, things like Berkshire Hathaway, Procter and Gamble, Coca-Cola. Think about these stodgy blue chip stocks that tend to do good throughout multiple parts of the economic cycle. They're not always cheap and they rarely are undervalued, but when people look at them, they see a robustly profitable, well-managed company that returns capital to its investors in a conservative manner using buybacks and dividends. And quality investing is just a systematic way for us to identify these companies and weight them over just subjectively picking stocks.
Absolutely. And I think that whole competitive moat, those blue chip, leading companies in each of the different sectors is really what it's trying to achieve. What are the other sort of widely recognized factors that are out there, and where does sort of quality fit amongst
So
them?
this depends on which index company you go with. So if we go with MSCI, which is one of the biggest publishers of factor research, quality is one of many factors. You have low volatility, which we went over before, stuff like ZLB and ZLU that are screened for low beta and sensitivity to the economic cycle. You have the dividend factor, right? You're looking at both companies that have grown their dividends sustainably and also higher yielding companies. You have, of course, broad beta, which is what we just talked about, broad market exposure. So things like the S&P 500, where you're just trying to capture what we call the market risk premium, being invested in equities just agnostically in the first place. There's also the size premium, which says that, historically you've been compensated for holding companies that have a smaller market cap. They're higher risk, but historically you've also earned a higher return premium. We also have the value factor, which says that, if you buy companies with low price to book, price to earnings, you should be compensated for that. And finally, we have momentum, which is kind of buy high, sell even higher. Is that companies that have strong price returns in the near term are likely to continue that. So the main takeaway here is that all of these factors have been systematized using indexes. You can capture them in a systematic, rigorous way, and there's a ton of funds out there tracking these. So instead of trying to implement it on your own, it's already being done on your behalf.
Absolutely. And I like the way MSCI sort of recognizes factors. They have to have those four criteria. They have to be proven. There has to be that robust data to support it. They have to be persistent through different market cycles and endure over time. They have to be explainable. So there has to be some sort of numeric proof or like foundation supported by research. And then they have to be investable. It has to be liquid and scalable in a strategy. So I really like the way they sort of look at it like that. One thing about the quality factor, some people call it a muddy factor, but it can be interpreted, differently by different portfolio managers. There's different ways to measure it. What are the typical variables that quality investors might look at to measure a company?
There's a good paper called What is Quality by Jason Su, Vitaly Kolesnik, and Engin Kosei. And it's called What is Quality? And what they found is basically that the definition is rather quite malleable, but there's a certain number of metrics that consistently are able to capture the so-called quality factor. So some of the ones you might look at include return on equity or ROE. And this is a measurement of how effectively a company uses its internal investments to generate earnings growth instead of relying on debt. So an example I'd like to use for this is Target. Target is your typical retailer. It has terrible margins. I think like 3% net margins, right? There's a lot of SG&A costs there to, sell things in the retail environment. But Target's ROE is in the double digits because with what it has, it's able to consistently grow its earnings despite not having the best margins. Some of the other metrics that you want to look at when you try to screen for quality includes earning variability, right? If you have a company where the earnings are jumping all over the place, it's like boom or bust. That's not really something that you would want to hold long term. That's something you want to trade out of. And finally, leverage is an ever-present factor. You want to look for firms that employ low financial leverage. So some companies that I would say have junk quality or just not good at all are mortgage real estate investment trusts. The very nature of their business model requires them to be highly leveraged to benefit from the spread in interest rates, right? All they do is hold mortgage-backed securities. So in order to basically exist, they have to be highly leveraged. And typically you won't see these companies at all in quality strategies.
Perfect. And you mentioned MSCI is one of the leaders in providing indexes around different factors. BMO's quality ETFs do track the MSCI index. Wondering if you can give us an overview of how that methodology works for BMO's products.
Yeah, sure. So there's multiple variants of the MSCI Quality Index, mostly corresponding to different geographies, but they all have three things in common. So what I mentioned first, they all screen for high return on equity. Second, they screen for stable year-over-year earnings growth. As I said, we want to avoid those companies with the big boom and bust cycles. You want ones that steadily grow their earnings. So think of things like consumer staples like Coca-Cola. And as I mentioned, low financial leverage. So what this ends up screening out is a lot of these financial companies that, like even value investors try to screen out because it's very hard to value them and they employ a lot of leverage. Some other things the MSCI indexes do is that they market cap weight them, but also it's a composite. So we don't just emphasize the biggest companies. We take the size and we also look at the quality score based on usually these three factors. And a lot of these indexes will also implement caps on specific securities to make sure that a single company that's outperforming, like Nvidia, doesn't dominate the entire index. So you don't get that security specific risk.
Yeah, that concentration. I really like the low leverage screen. Like if you want to focus on quality companies, you want to make sure that they're carrying less debt, that they're funding their businesses more organically, and they're going to be more resilient through tough times as they're not going to be saddled by all this debt. And as Warren Buffett says, you're really screening for those companies with competitive moats, and he's probably the best example of the quality investor.
Absolutely. Warren Buffett is a quintessential quality investor, but he does it more qualitatively. He talks about the wide moat, and he's mentioned that you can't say that a moat is like 5 foot wide and 9 foot deep. It's really hard to quantify. So he's got some of that secret sauce that very few people have been able to capture.
Well, exactly. And we're going to talk about why ETFs are so effective, but think of the amount of time it's taken him to develop his strategy, the
Absolutely.
skill that is involved. Talk to us a bit about how the quality factor has performed over time generally.
So there's a good paper from the CFA Institute called FAMA in French, the five-factor model revisited by Derek Horstmeyer, Ying Liu, and Amber Wilkins. And what they say here, quote, robust minus weak, or the excess returns of companies with good profitability versus the ones with bad profitabilities, is the single factor that has consistently delivered excess returns over all economic cycles since 1963. Going long high quality stocks or profitable firms and shorting their low quality unprofitable counterparts has been a great investment strategy, right? It's consistently outperformed the market, and quality is tends to be a less cyclical factor than, say, something like value, which can go in and out of favor very dramatically. Like for the last decade, value premium has been completely absent. The outperformance has mostly been from growth stocks, right? Same with the size premium, but quality is more durable.
Absolutely. More defensive. Why today? Why today for an investor? Why is quality a good fit right now?
It's a good fit today for the same reason it's a good fit pretty much in every day. There, if you are a long-term investor, your goal is to buy profitable firms with a durable competitive advantage at a fair or undervalued price. If you're lucky, you get an undervalued price, but more often than not, you're getting fair. You want to make sure that the company's cash flows you're paying for today is at a price that you're not overpaying for, and it's expected to continue growing that. And that assurance, that margin of safety, is more present if you can screen against the things that would cause you to suffer like 80-70% loss, typically bad financials, excessive use of leverage, poor return on shareholder equity. By systematically eliminating these variables, you are in effect taking out some of the major contributors to underperformance. I call it outperforming just by not losing.
Very good. And I think there's a lot going on in the market today right now that are making investors look towards those lower volatility, more defensive approaches as well, like a quality approach. Um,
Absolutely.
Talk to us a bit about, I kind of alluded to this, but why ETFs are such a good tool for investors who are looking to use a quality approach.
Factor investing is done most effectively when you can systematically and consistently implement the strategy. That is, you're sticking to a schedule for rebalancing. You have a well documented and objective screen for how you measure return on equity, leverage, and earnings variability. And you have a way to automate applying these screens to a universe of hundreds, even thousands of stocks. What we're trying to do is you're trying to isolate a subset of stocks into a couple of thousand that have these characteristics. And humans are not very good at this, but advancements in indexing and mathematics and algorithms have made it so that it is seamless when you automate it into a fund. And that's why the ETFs are good. Instead of screening 1,000 stocks and picking the 500 highest quality ones, I could just buy an ETF. Yeah, I'll pay the management fee to not have to do all that work. Right? I pay the management fee to not have to turn over the portfolio myself to rebalance. And every year when it reconstitutes, I don't have to repeat the same process manually. I can make one transaction and be done with it.
Yes, very good. And BMO offers three different quality ETFs. Most popular ZGQ, which is the BMO MSCI All Country World High Quality Index ETF. Management fee is 45 basis points. So very reasonable there, relative to what it would cost you to do it yourself on something like this. We also have
Absolutely.
yeah. Sorry, were you going to add something?
Yeah, I was gonna say ZGQ is just one of those ETFs that a lot of people use quality as a satellite. So you have your main portfolio, which is broad market, blend value and growth styles all together. But then maybe you add a quality or value tilt. I would argue, and personally, I would be using ZGQ as a core. Now, if you're a long term investor, I think quality is one of those consistent factors that you'd be buying through thick and thin. You don't have to try and time it like value. You don't have those long decades of underperformance like size, right? It's just something that I personally feel comfortable holding. And if you look at the data from November 2014 to today, ZGQ has returned an annualized 14.32%. And when you look at something like the iShares MSCI World Index ETF, that's only returned 11.44. The Sharpe ratio, or the risk adjusted return of ZGQ, is 0.74 versus 0.61 for the MSCI World Index, right? That's clear outperformance dating back a decade and longer if you just backtest the index by itself.
Yeah, I encourage you to check it out. You can use our free tools online too, BMOETFs.com. The comparison tool is a great way to put ZGQ up against just about any ETF out there, and it's gonna look good. The other two, of course, ZUQ is the US High Quality Index ETF that is also available in USD and hedged and unhedged. And then ZEQ, the BMO MSCI Europe High Quality Hedged to Canada ETF. So those are our three options that you can check out. Tony, thank you so much for joining us today. I said off the top, quality factor is definitely an intuitive factor for investing, and certainly ETFs make it simple to use. But I appreciate all your insights today, and I hope to have you back again soon.
Absolutely, it's a pleasure. Just if there's anything you could take away from this, it's that quality is evergreen, right? There's not going to be a scenario where you are going to be left hurting over the long term buying quality stocks. Of course, you don't want to overpay for them, but by doing it, by automating contributions in a systematic manner and using a smart beta ETF like ZGQ and ZQU, you're able to harvest this premium, as the saying goes.
ZUQ, you mean?
ZUQ, yeah, not ZQU.
All right. Thank you so much, Tony. Next week, we will be back with part 2 of our free BMO ETF tools demo. We did the first part with Kevin Prince a few weeks ago, walking through the first few new tools that we launched. So we're going to walk through the second tranche. These tools, again, are available on BMOETFs.com for free. Last but not least, I want to give one last plug for Tony's site, which is ETF Portfolio Blueprint.com. Check it out. And comment below if you like today's episode. So thanks again for joining us, and we will see you next week. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.